Okay, let's just dive right in. We are looking at a truly, a seismic after-hours session. It's one of those high-stakes, fast-moving environments where the fortunes of these huge tech giants, they're basically decided in, what, 60 minutes?
Less than that sometimes.
Exactly.
Yeah.
And our mission, like always, is to pull the real signal out of all that noise, all that post-close volatility.
Yeah.
And today, wow, that signal is an absolute shockwave.
It really is. And that shockwave is the ultimate lesson in market momentum right now. I mean,
Yeah.
you have two titans in the same space, Dell and HP. On paper, they live in the same world, right? Traditional computing.
Right.
But after the bell rang, their financial universes just ripped violently apart. It is the perfect example of a fork in the road. And it proves that in 2025, even if you're a legacy company, you have to have an AI story. You just have to.
You cannot ignore this divergence. The headline just screams conflict. It screams opportunity. Dell Technologies, buoyed by the one thing the market actually cares about, gained more than 3% in extended trading. Meanwhile, their biggest rival, HP, goes into an absolute freefall. It drops more than 6% in the exact same session.
That's almost a 10% swing between two companies that make PCs. It's incredible.
It is. The market isn't just, differentiating between them. It is actively punishing one and, well, aggressively rewarding the other.
And the key thing to understand is that this distinction, it isn't really based on last quarter's results. I mean, those were kind of messy for both of them, if we're being honest.
Yeah, they were.
The difference and the real driver of this huge reaction is all about the future. It's about how the market sees their, let's call it, structural exposure to AI infrastructure. One company is the indispensable tool seller for the AI gold rush. They're commanding premium prices. They're putting out spectacular guidance.
And the other?
The other is getting hit by the cost inflation from that very same gold rush. And they're announcing layoffs for up to 10% of their workforce just to stay alive for the next decade.
That's the structural split. It's critical.
Right.
Okay, so let's start with Dell, the clear winner here, because the initial data has this perfect paradox in it.
Yeah.
If you just glance at their Q3 earnings, they were actually mixed. They reported Q3 non-GAAP earnings of $2.59 per share, which, it did beat the consensus of $2.47. So that's a win on the bottom line. Good for profitability.
But, and this is the kicker, this is what really tells you about the market's mindset right now. Their Q3 revenue of $27.01 billion actually missed the street's estimate. It missed. The estimate was $27.13 billion. So technically, that's a top-line miss. And historically, in any other market, a revenue miss, well, that would put immediate pressure on the stock. Doesn't matter if you beat on EPS.
But not in lead 2025.
Not at all.
Investors basically looked at that tiny revenue miss, crumpled it up, and just tossed it in the trash. Because the forward guidance, the forecast for what's coming next, was so unbelievably astronomical. Guidance isn't just king right now, it's the entire monarchy.
It really is. Dell gave a roadmap that wasn't just, a little bit of growth. It was a fundamental structural leap forward.
Paved entirely with AI servers.
Entirely. To really get the scale of this, you have to look at the forecast for the current quarter, Q4. This is where they lit the rocket fuel. Dell is projecting total sales at the midpoint of their range to hit $31.5 billion.
You have to shout that number. $31.5 billion. The street's estimate was only $27.59 billion.
It's a nearly $4 billion beat on the forecast for a single quarter. In mature tech, you do not see a quarter-over-quarter leap of that size unless there was a massive acquisition or something.
Right, like a once-in-a-decade product launch. But no, this is just server demand.
It's demand.
And the earnings per share followed right along with it, which signals this isn't just low-margin volume they're pushing. They're forecasting a really robust current quarter EPS of $3.50 per share.
Yeah.
That blows past the analyst forecast of $3.21.
So this isn't them just, surviving a PC slump. This is a complete structural re-rating of the company based on a totally different high-value business.
Let's drill down into that AI server thesis. Because Dell isn't just making vague statements like, oh, we're benefiting from AI. They are putting hard, aggressive numbers behind it.
They are. They actually boosted their overall revenue forecast just for AI server shipments to a stunning $25 billion.
And that was up from what, $20 billion?
Up sharply from a prior forecast of $20 billion. That is a 25% increase in their own internal projection for their fastest growing segment.
And that confidence, it just flows right into their overall corporate outlook.
Exactly. The full-year revenue target got boosted to $111.7 billion. The previous target was $107 billion. This is why the stock is surging, even while the rest of its business, the Client Solutions Group, PCs and laptops, is still pretty soft.
Mm-hmm.
Dell has cemented itself as a major bellwether for the health of the entire AI infrastructure market. And that's specifically because they're a top builder of server systems that use NVIDIA's powerful GPUs.
The analogy is perfect. Dell is selling the high-powered custom shovels in the AI gold rush. They aren't the ones developing the models, but they are providing the muscle, the hardware. And the market is paying a huge premium for those tools.
Absolutely. And the really crucial point here for anyone analyzing this is their customer segmentation. So who exactly is buying these $25 billion worth of shovels?
Right, because it's not just the usual suspects.
No. While the traditional hyperscalers think AWS, Google, Microsoft, they often just buy GPUs directly from NVIDIA.
They just bypass Dell?
Right, they have the scale to do that. But Dell is winning huge business from this other very lucrative and fast-growing tier.
Which is large enterprises, governments, and what they're calling neocloud providers. We should probably define neocloud for a second, because that's driving a lot of this.
For sure. The neocloud providers, companies like CoreWeave or Iron Ltd., are basically specialized infrastructure firms. They build these massive cloud data centers that are specifically optimized for the intense demands of AI and large language models.
And then they just rent out that capacity.
Exactly. They rent out that raw, high-performance GPU compute power to other companies that need it but don't want to build a data center themselves. You can think of them as the AI-native landlords of the cloud.
And we just saw a perfect example of this. The sources pointed out Dell announced a huge deal to ship NVIDIA GB300 systems to Iron.
And Iron plans to rent that capacity out to massive users, potentially even Microsoft.
So that chain of business just shows you how deep the AI demand is penetrating. It's way beyond just the 5 biggest tech names.
And you see that penetration in the numbers for their Infrastructure Solutions Group, the ISG.
That's their high-margin server division, the financial airbag we were talking about.
That's the one. Last quarter, ISG delivered $14.11 billion in sales. Right in line with what people expected, so stable. But inside that number, the server and networking sales were the absolute star. That segment brought in $10.1 billion, a remarkable 37% annual increase.
Okay, let's just pause on that. 37%. In a mature industry like enterprise computing, that's not just growth, that's a complete market redirection.
It is. And of that segment's sales, a staggering $5.6 billion was spent specifically on AI servers in one quarter. This is why Dell's leadership, from Michael Dell to Jeff Clarke, they're so bullish.
Clark's quote really nailed it. He said, AI momentum is accelerating, Dell is winning, because of our unique ability to engineer bespoke solutions.
And that word bespoke is the key. They aren't just shipping standard boxes, they are custom engineering the cooling, the power, the networking, all to handle the extreme heat and energy draw of thousands of NVIDIA GPUs working together.
That customization is what locks in the high margins.
And the client loyalty.
But wait, let me push back on this a little. What about their Client Solutions Group, the old PC business? That still brought in over $12 billion. The market can't just be ignoring that softness forever, can it?
That's the critical question, and it's why Dell's stock, even after this pop, still has some ground to make up. Yes, CSG is a drag, no question. But the market is doing simple math right now. The growth rate and the margins of the ISG are so much better, and the sheer scale of the AI opportunity, that $25 billion forecast, is so big that it just completely reweights Dell's valuation.
So the thinking is, even if the PC business is flat for 2 years, the AI momentum alone justifies the stock going up.
Exactly. They have that financial airbag, and right now it's fully inflated.
Okay, so now we have to flip the coin and look at HP, because this is the other, the brutally painful side of this tech divergence.
It really is.
HP's results, on the surface, they weren't a total catastrophe, but the future they painted was just grim enough to wipe, 5.7% off their stock post-market, and then it fell even further.
Over 6% in total extended trading, and yeah, you're right, the Q4 results themselves at face value were fine. They were okay. HP reported Q4 EPS of 93 cents per share. The analyst estimate was basically the same, 0.9315, and sales, $14.64 billion. They actually beat the $14.48 billion estimate.
So they met the bar. They even grew revenue 4% year over year.
They met the bar, but in this market, a momentum-driven, forward-looking market, just meeting the bar is the same as failing.
Right.
The market looked right past Q4 and focused entirely on the guidance collapse. HK's forecast for the first quarter of 2026 was the absolute investor killer.
Let's get into those numbers.
For Q1 2026, they're forecasting earnings between 73 cents and 81 cents per share.
Which, I mean, the midpoint kind of brushes up against the consensus of 79 cents, but the range is so wide it just signals uncertainty.
Massive uncertainty and margin pressure. But the real structural concern came from the full-year forecast. Full-year 2026 EPS. They guided to between $2 and $3.20 a share.
And that, critically, is way below the analyst target of $3.33. That's a huge miss. And then they didn't even issue revenue guidance, which just suggests they have no visibility.
When a company in a traditional sector misses future targets by that much, it tells the market two things at once. One, the immediate headwinds are just ferocious. And two, radical, expensive structural change is coming.
And by structural change, you mean layoffs.
Massive multi-year layoffs.
Yeah, the restructuring shock, that was maybe the biggest headline. They announced this drastic plan to lay off between 4,000 and 6,000 people.
Which is up to 10% of their entire workforce.
Right.
By the end of fiscal 2028, this isn't a quick fix. This is a multi-year downsizing program that just screams deep internal worry about their long-term health.
So you have to look at the cost versus the goal here. The goal is to save at least $1 billion a year by 2028.
Which is ambitious, but achieving that is extremely expensive in the short term. The cost of this whole thing is projected to be around $650 million in charges.
With a massive $250 million of that hitting in fiscal 2026 alone.
Exactly.
Hold on, let's challenge that for a second. They're laying off 10% of their people, taking a $650 million charge, all to save $1 billion over 4 years. Doesn't that just suggest they have zero faith that the core PC and printer market is going to recover? That their only answer is just internal surgery?
That is precisely the market's skepticism. The CEO, Enrique Lores, he tried to frame it as an initiative to transform the company, adopt more AI automation, customer support, and internal processes.
He's trying to spin an AI story.
He's trying. He said this is about staying competitive for the next 10 or 20 years. But here's the critical distinction. Dell is using AI externally as a growth engine. HP is using AI internally as an expensive, necessary cost-cutting tool to prop up margins that are otherwise just eroding.
So Dell's AI story is about expansion. HP's is about survival and contraction.
Yes, and the deep irony is that Dell's success is actually making HP's survival even harder.
How so?
Well, while HP is doing this huge internal overhaul, they are getting squeezed by this brutal financial headwind in their PC business. The surging demand for high-end memory chips for AI data centers, the exact thing Dell is capitalizing on, is driving up the price of memory chips for regular PCs.
So Dell is basically taking all the supply and raising the price floor for everybody else.
Precisely. HP's CEO said that memory costs are now 15% to 18% of the cost of a typical PC. They knew an increase was coming, but it accelerated really fast in the last few weeks. And the consequence is severe. They expect a net headwind of about 30 cents per share in the current fiscal year.
30 cents per share. Wow. That is a devastating number. I mean, if analysts were only forecasting around $3.33 for the whole year, losing 30 cents means they are giving up almost 10% of their profit before the year even starts.
It's a crisis. It immediately drags down their outlook and forces them into these painful moves, like raising PC prices and desperately trying to find cheaper suppliers. They're passing the cost on to consumers, but that risks losing volume.
And if we look at their segments, their personal systems unit, the PC business, it actually showed some strength. Revenue was $10.35 billion, up 8%.
It was, but that 8% growth is now completely overshadowed by that looming 30-cent margin headwind, so that volume probably came at a cost to profitability.
And their other pillar, the printers business, is making it worse. It brought in only $4.3 billion, down 4%, and missed the forecast. And that segment is stuck in a pricing war. They can't just raise prices there.
So they're caught in a perfect vice. You've got inflation from the AI boom on one side and a brutal pricing war in printers on the other. And all this is happening while they're trying to execute this massive internal overhaul.
So this brings us to the common thread connecting both of them, which is the PC refresh cycle, the end of Windows 10 support.
Right, and it's a huge market force. Microsoft officially ended support last month. For any large enterprise or government agency that cares about security, you have to upgrade. It's a forced capital expenditure cycle.
And the opportunity seems massive. HP's CEO said that only about 60% of their installed base has moved to Windows 11.
That means 40% of their enterprise customers are an upgrade opportunity just sitting there. Dell's COO said the same thing, that it's a coming sales boost.
So the demand is coming. But the key difference, the reason for that 10% market divergence, is who has the financial buffer to just wait for it, and who desperately needs it right now.
That is the absolute crux of it. Dell has the massive AI server business, that ISG safety net we talked about. It's already growing at 37% annually. They can afford some softness in PCs while they wait for the Windows 11 cycle to really kick in next year.
But HP is operating completely without a net. Their whole future is exposed to the speed and the cost of this shift. They don't just need the Windows 11 boost for revenue.
No, they desperately need it to offset that crippling 30-cent memory cost headwind. They're cutting 10% of their people to chase $1 billion in savings by 2028. That signals deep, deep concern about their margins if that Windows 11 cycle doesn't hit fast and profitably.
And you can see all of this in the year-to-date scorecard. As of the close, Dell YTD is up 7%.
Okay.
HP YTD is dramatically down 27%. And for context, the S&P 500 is up 15% this year.
That YTD gap is the market's report card. HP is lagging the market by over 40 percentage points. That's pricing in the inflation, the disruption, the slow growth. Dell is lagging the market by about 8 points, even after delivering this massive forward guidance.
Let's talk about that lag for Dell. If the AI story is so good, why are they only up 7% YTD when the S&P is up 15%? Is the market just being too conservative?
That's the core debate right now. The market is waiting for proof. Yes, the guidance for Q4 is spectacular, but the PC business still made up the majority of their sales last quarter, over $12 billion. The fear is that the low margins and volatility of the PC business will keep dragging down the momentum from ISG. So investors are rewarding the guidance, but they need to see sustained execution before they push Dell past that 15% market average.
It really feels like HP is in this desperate, expensive fight to automate its way out of trouble, just hoping to survive until the Windows 11 catalyst kicks in.
While Dell is just riding this massive wave of AI spending, and they see the PC cycle as a nice little bonus, not a necessity.
A perfect encapsulation. One is playing high-stakes defense, the other is playing high-growth offense. Okay, let's pivot really quickly. Let's do a lightning round. We're moving from legacy tech to the super high volatility world of EVs, and specifically NEO.
A great contrast.
It is. You have this classic tug of war between institutional pessimism and, well, retail euphoria.
NEO is under such intense scrutiny. The U.S. shares fell over 4% on Tuesday, but then they edged up a tiny bit after hours. It just reflects that extreme tension. The analysts are pulling one way, the retail traders are pulling the other, and you just get this choppy, unpredictable stock.
So what's driving the institutional gloom? It was mostly the Q4 vehicle volume guidance, right?
It was weak. They guided to 122,500 units at the midpoint for Q4. Their earlier, more optimistic outlook was closer to 150,000.
That's a big cut.
A huge reduction. It immediately signals slowing momentum and a really tough competitive environment in China.
And the big banks reacted immediately. Macquarie downgraded NEO to neutral, cut their price target to a pretty cautious $5.30.
Yeah, and they see weak demand all the way through the first quarter of 2026. BofA also lowered their price target down to $6.70. The consensus on Wall Street is pretty clear. The near-term outlook is soft.
So, okay, a clear consensus from the institutions. But then you look at retail sentiment, and it's like you're talking about a completely different company.
That's the power of a growth narrative, especially in a speculative sector like EVs. Morgan Stanley, they maintained an overweight rating and a super bullish $9 price target.
So they're just ignoring the Q4 weakness.
They're consciously ignoring it. They're focused entirely on the company's cost management and the future product pipeline.
And those cost management plans are pretty serious. They cited NEO's goal of hitting a 20% gross profit margin in 2026. That's their Achilles heel, right? Profitability.
It is. And they're backing it up with real cuts. Capping R&D expenses, keeping administrative costs low. Morgan Stanley believes all this could get them to non-GAAP profit break-even in 2026. That's the holy grail for an EV maker at this stage.
And that's the future story that's fueling the retail base. On places like StockTwits, sentiment was pegged as extremely bullish.
And I saw that poll.
Yeah. 65% of voters believe NEO has the strongest 12-month outlook, better than Tesla, which is only at 22%. That's incredible confidence, and it's anchored completely in future potential.
It's a classic belief in the turnaround story. The retail army is completely tethered to these future product launches. Morgan Stanley mentioned 3 big SUVs coming in 2026. The thinking is that this weakness now is just a pause before a huge product surge next year.
So it's the battle of the numbers versus the roadmap.
That's the nature of EV investing. You're betting on a 2-year outcome, not a 2-month outcome.
What a dramatic session. So to summarize the day, the market is just ruthless and has a singular focus right now. Past performance is totally irrelevant. All that matters is a compelling AI story or really robust, profitable forward guidance.
Yep. Dell won by selling the custom high-powered tools to the AI market. HP lost by having to incur these immense costs just to survive the very wave that Dell is riding.
So what's the sharp prediction? What should investors be watching for when the bell rings tomorrow morning?
The immediate focus has to be on HP's pricing power. Their CEO said they are going to increase PC prices to offset that 30-cent memory headwind.
A delicate balancing act.
The most delicate in the market. If they raise prices too much, they'll lose volume. If they don't raise them enough, their margins get crushed. The market is going to react to any signal that they are losing ground on volume because of those higher prices.
And on the Dell side, what's the question there?
On the Dell side, the question is about that valuation. We said they're up 7% YTD, while the S&P is up 15%. Will this massive guidance finally be enough to push Dell past the market average?
To prove that the ISG is big enough to overcome the anchor of the PC business.
That is the true test of this AI pivot. The market rewarded the guidance, but the stock still has ground to make up. If Dell opens strong tomorrow and holds that strength, it signals full confidence. If it settles back down, it means that PC business is still too big of a weight.
Can Dell move from an AI success story to an overall market leader? That's what we watch tomorrow.